How is everybody doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. Today, we're going to be taking a look at something called a merger of equals. What is a merger of equals? What does that mean in the banking business? And then we're also going to look at an example of a merger of equals recently. And we're going to take a look and we're going to be looking at a Substack article written by Paul Davis, who recently just did an interview with the show. If everybody wants to go check that out, they could check it out, episode 347, which was my interview with Paul Davis from the Bank Slate. So please check that out when you get a second. Like I said, we'll be looking at his Substack article here in just a second. But first, what is a merger of equals? So a merger of equals is when two firms of about the same size come together to form a single new company. In a merger of equals, shareholders from both firms surrender their shares and receive securities issued by the new company. Companies may merge to gain market share or expand into new segments of their existing market. Usually, a merger of equals will increase shareholder value. So a couple of takeaways here. So a merger of equals is the process of two similarly sized companies joining together to form one company. The benefits of a merger of equals include operational synergies, cost reductions, and expansion into additional markets. The joining of two different corporate cultures is a difficult aspect of a merger of equals and must be handled swiftly and decisively at the onset. There is an important distinction between a merger of equals and an acquisition. And then it goes into, kind of understanding a merger of equals, antitrust considerations, that kind of thing. But we'll kind of skip that for the moment. And so this is from Substack, and this is basically the Bank Slate. Like I said, this is the article written by Paul Davis here, and this is called "Last Minute Bid Failed to Foil Berkshire Brookline Deal." An unnamed company made an offer to buy Brookline after the Wall Street Journal leaked news of its talks with Berkshire. So we'll get into this in just a second. So I just want to say that merger of equals in the banking business is a pretty common thing. It happens quite a bit, and typically what you'll see is a lot of you'll see a bank that's maybe about 600 million in assets, and there's another bank over here that's about 450 in assets, and pretty not dollar for dollar, but pretty close to being equal, and they'll merge together. Why do they merge together? Well, if they merge together, they become a $1 billion plus bank, have a lot more to work with in terms of assets. They have more capital. They could grow the bank quicker, even though they may have to take a step back in the short run by, they have to, in other words, they may have to make reductions in the short term to maximize the efficiencies of the bank and get all the numbers back where they need them to be. Because again, you don't need two of everything. So a lot of times, a lot of positions have to be cut. Some of the branches might be closed and stuff like that. Because they have overlap. So after the merger is put together and it's kind of cleaned up a little bit, then a lot of times they're put in a really good situation. But culture can be a major impediment to having a successful merger here between two equals. So let's take a look at this example here real quick. So Paul starts out by saying, "Hi, Bank Slaters. It's been a while since we've broken down the backstory behind a high-profile bank merger, mostly because we haven't seen too many. The slow pace of M&A has left us waiting for something compelling to show up in the S4s. Well, the wait is over. Berkshire Hills Bancorp's pending $1.1 billion acquisition of Brookline Bancorp offers a deep look at the merger of equals. Berkshire shareholders will own a majority of the stock. The deal combines similarly sized Boston-based banks and reflects months of quiet negotiations, intense modeling, and a last-minute late-night phone call. So let's break it down." And wait a minute. I got here. I thought I had the rest of it there, but that's okay. I got the rest of it here. I'll just read it out to everybody. So sorry about that one, guys. So, okay. So after years of informal talks and overlapping M&A ambitions, Berkshire Hills Bancorp in Boston agreed to buy Brookline Bancorp in Boston in a deal that capped off months of confidential talks, detailed financial modeling, and an 11th hour bid from an unnamed bank. The $12.3 billion asset Berkshire agreed in December to buy the $11.9 billion asset Brookline for $1.1 billion in a deal expected to close in the second half of this year. Berkshire also raised $100 million of capital by selling common stock. Berkshire and Brookline aren't strangers to deal making. Brookline chairman and CEO Paul Perrault orchestrated 4 acquisitions since his leadership began in 2009, while Berkshire has brought 10 banks and 20 Bank of America branches since 2005. So formal talks began in February of 2024 when Mary Ann Callahan, Berkshire director, approached Perrault to discuss a possible merger, according to a regulatory filing tied to the pending acquisition. Over the next few months, the companies worked on the governance and management structure, aligning on a framework that would put Perrault as CEO, with David Brunel, Berkshire's chairman, retaining that role. So hammering out the terms. So Berkshire's board was informed about the talks during an April 30th dinner. Though the board considered another M&A options as its May meeting, the directors determined that other potential strategic partners were only theoretical at this stage and were unlikely to be as advantageous of an operational and management fit as Brookline, the filing said. Brookline delivered a non-binding term sheet on June 3rd that proposed a fixed exchange ratio of 0.4365 shares of Berkshire stock for each Brookline share, with Brookline as the accounting acquirer and Berkshire as the legal one. A 14-member board would be evenly divided between the two institutions. Berkshire's board pushed back, believing the valuation implied in the proposal was too high. Over the summer and into the fall, due diligence continued. Berkshire's board created a special committee to evaluate the deal and hired Raymond James as an advisor. Brookline brought on Hooved Group. On multiple occasions, the companies extended a confidentiality and an exclusivity agreement, letting them continue exploring a deal while reviewing financial, operational, and governance details. Pricing negotiations continued into November. Brookline's proposed a 0.4228 exchange ratio led to a counterproposal with a 0.4036 ratio, with the companies finally agreeing on a 0.42 ratio. Berkshire also prepared a concurrent $100 million capital raise priced at $29 a share to support the transaction. But just before the deal was finalized, an unexpected bidder emerged. So on December 14th, the Wall Street Journal reported on the talks, prompting the CEO of an unnamed bank to place an evening call to Perrault. The unnamed bank offered to buy Brookline at a 20% premium, or roughly $15 a share, contingent on due diligence and negotiating definitive terms. Brookline's board, after weighing the proposal and its inherent execution risks, rejected it and unanimously supported the merger between them with Berkshire. The filing noted that Brookline's board also preferred a deal with Berkshire because it preserved Brookline's executive team and included board influence. So the deal was officially announced on December 16th. The combined organizations will be in an even stronger position to deliver exceptional client experience and greater value for shareholders. Berkshire's president and CEO, Nitin Mhatre, said in a press release announcing the deal. So Berkshire expects to cut 12.6% of the combined company's annual operating costs to lower its efficiency ratio to 48% in 2026. Berkshire plans to incur $93 million of merger-related charges. The deal should be 40% accretive to 2026 earnings per share. It should take less than 3 years to earn back any dilution to Berkshire's tangible book value. Though the company said that Berkshire will rebrand under the as yet to be determined name and stock symbol, the new filing states that it will trade under its current symbol when the deal closes. The combined bank will be divided into 6 regions, each with its own president. The 4 existing bank charters will be consolidated into a single Massachusetts state charter under a new brand. The filing said Brookline Bank would be the surviving entity of the charter consolidation. So very interesting there. We get kind of a look. We got kind of a look inside, and this is also interesting just from a pure merger perspective, giving you kind of a glimpse as to how a typical merger between two banks works. Gives you some of the deals there. Hey, they kind of start the conversation. You got, somebody from one bank has to reach out to the other bank. Then that CEO has to then take that offer back to the board, talk about it. The board says, yeah, okay, we're okay with it. Then they basically enter into formal talks. You get basically a term sheet proposal. And then you get the investment bankers involved. Then you got the NDAs, the exclusivity agreements. And then basically the due diligence kicks off from there, go through the whole due diligence period. And then as you progress through due diligence, then the negotiations really kick in, as we talked about with the different ratios. And you eventually hammer it out. But then, as this example also illustrates, you can have these very last minute things come up, i.e., another proposal from another bank comes out. It could completely come out of the blue because, unfortunately, even though you have the NDAs, even though you have the exclusivity agreements, all this kind of stuff, unfortunately, news of the transaction or maybe a pending transaction, eventually will leak out. And it obviously leaked out to somebody else. And, some other bank said, hey, we need to maybe try to jump in on this thing before it gets its final. But despite the fact that this other bank came in with a really attractive offer at the end of the day, you also have, if you're that far down the road and you're about to consummate the deal, you do have breakup fees at that point. So if you're gonna break the thing off, you may have some steep penalties that you have to pay by that point in time. And they have to weigh that with the other offer, which I'm sure they did, and then they come out and have to make their final decision. Now, this bank should be a pretty substantial bank. You're talking about one bank was a little over 12 billion in asset size, the other bank was a little over 11. So you're going to have a 23, 24 billion dollar bank sitting there at the end of the day up there in Boston, which should enable them to be a pretty sizable competitor in that marketplace. So again, this is the kind of thing that you could do with a merger of equals. Like again, there will be some pain in the short term as they, kind of reorganize the two institutions, make cuts to staffing and branches and things like that, get things reorganized. But in the long term, this should pay off very nicely down the road as you have a much bigger, more efficient institution with a lot more capital at hand and can really continue to grow in the market and really do good things. So with that said, I hope people really like this episode. Please go check out the Bank Slate, Paul Davis over there. You could check out the website at the Bank Slate, www.thebankslate.com. You could check out Paul Davis on Substack. So I would highly recommend you do that. But if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. And as always, make sure to check out some of the other content on the channel. Thank you so much for listening, and I'll see everyone again real soon. Take care.